Joining us now, former Office of Management and Budget Director, former acting White House Chief of Staff, Mick Mulvaney. Mick, great to see you. I'll describe First Republic's business just like Silicon Valley Banking's signature was aggressive rich people rump smooching, handing out loans to rich folks at like 1%. Dumb. But what does this mean for regular working people? Certainly, they're going to pay higher costs to these big banks, including J.P. Morgan, because the FDIC insurance fees are going to go up.
Yeah, Dagan, the discussion right now is obviously whether or not these insurance limits are going to go up. Right now that you're limited to $250,000 of insured FDIC deposits. A lot of discussion, both in Washington amongst lawmakers and the regulators, is to take that up perhaps to infinity. That's not free. Someone's going to pay for that, and it's usually folks who have the money on deposit. So it's going to be interesting to see how it shakes out, whether or not there's going to be any risk at all, or if the government is going to say, look, banking is going to be a risk-free sort of process. That costs money, and at the end of the day, it usually costs taxpayer money. Of course, they'll say that it costs depositors money, et cetera, but at the end of the day, the insurer of last resort appears to be the federal government, which is a dangerous precedent to set.
So as you'd expect, Mick, Biden today called on Congress to strengthen regulations. Listen to this.
And so let me be very clear. While depositors are being protected, shareholders are losing their investments. And critically, taxpayers are not the ones that are on the hook. I've called on Congress to give regulators the tools to hold bank executives accountable. And I've called on regulators to strengthen regulations and supervision of large and regional banks.
So, Mick, to quote Joe Biden himself, that's malarkey. There's enough regulation in place to actually make sure banks are safe and sound. The problem is you didn't have regulators on the beat to make sure that you didn't have these banks fail. Am I wrong?
Yeah, Sean, it's the same thing we saw with Silicon Valley Bank and Signature a few months ago, which was that supposedly it was the Trump-era changes and regulations that led to this, and that is the bunch of malarkey. This was a simple problem between the duration risk. They had lent money out long-term and invested short-term, and that was a problem for them. So that is something that an ordinary regulatory investigation would turn up at any level. So we went from here to here in terms of regulation, but even regulation down at this level should have caught these sorts of deficiencies. The question is this: where else have the regulators made these exact same mistakes? Where else have banks got this duration risk on their books, but the regulators haven't caught it? That is the thing I think that is worrying the most people as we try and figure out, is this a one-off or a two-off, or is there a bigger problem here throughout the banking system? And I don't think we know the answer to that question.
Well, Mick, 60% of the total credit, and Stephanie Pomboy talks about this all the time, is created outside of the banking system. And the regulators don't have any control over that. And all of these problems were created by the reckless spending of the Biden administration and the reckless monetary policy of Biden's Federal Reserve. And I call it that because Jay Powell might have been appointed by Donald Trump, but he was renominated by Joe Biden.
This is a risk that you run in a rapidly increasing interest rate environment. The point, though, Dagan, is this: that's not rocket science. Everybody knows that. If banks have bought all these short-term paper and they've got low interest rates coming in, but they're paying out high rates of interest, they're going to have a problem. It's similar to what happened in the savings and loan crisis back in the 1980s. Yep. Again, the real surprise here is that anybody, including the regulators, in fact, most importantly, the regulators, are surprised by this.
Yeah, we don't need new regulation. Actually, just use the tools that you have and regulate the banks that you oversee. But I want to switch gears because Biden's mortgage rule begins today, Mick. Borrowers with higher credit scores will see higher fees in order to help cover those with lower scores. Let's look at the numbers. I'm not sure if you can see this or not, but let's say you have a $350,000 mortgage and you put down 20%. If your credit score is 640, your fees go down by more than $2,600. But Mick, if your credit score is 740, you have a better credit score, fees go up by $1,300. You could face an estimated cost of $30,000, Mick, because you have a better credit score. Isn't this really just socializing credit at the FHFA, number one. And number two, we saw Fannie and Freddie, when we came into Congress, they needed a bailout, hundreds of billions of dollars in a bailout. You would think they want good creditors with more money down and higher credit scores getting backed up by the federal government, as opposed to those who put 5% down and have lower credit scores. This is insanity.
Yeah, the thing that you read, I can't see that, but as you were reading out loud, the thing that jumped out at me is if you put 20% down on a house, nobody does that. Listen, we've been worried, Sean, since you and I were in Congress, about the politicization of credit. Elizabeth Warren really believes that credit is naturally political and that the government should be involved. Keep in mind, she's written papers in the past on how she likes the Japanese system where the post office is involved in the banking system so that the government is heavily involved. It's hard to make this up. It doesn't surprise me. This is where the Democrats want to sort of take everything. I'm here now in California at the Milken Conference in Los Angeles, where the state legislature is negotiating a bill or discussing a bill where people who make more money will pay more for their electricity. It just smacks of socialism. It's not just in credit, but it's certainly driving a lot of the discussion in credit. And every time a bank fails, even if the bank fails because of bad management and oversight by the regulators and not for the lack of regulation, every time that happens, it gives folks like Elizabeth Warren the chance to make her case again and move the needle in her direction.
Well, she can do that, and she can stick her fingers into the mortgage business, Mick, because we still, as a nation, still subsidize mortgages more than up to the tune of more than $1 million mortgage at the federal level. So they're the haves and have-nots based on what Sean was talking about, but Fannie Mae and Freddie Mac still exist. So that's the inherent problem. And so in every corner of our economy, Biden and company are meddling with regulations because they can.
That's right. I mean, look at that. We haven't talked about it today, but it's in the student loan market as well, right?
Right.
One of the reasons that the Democrats wanted to get a hold of student loans, keep in mind, that was part of Obamacare. That was part of the Affordable Care Act. They were going to take all of the money that you make off of spending, out of making student loans, and use that profit to pay for the Affordable Care Act. You can look that up. I'm not making it up. And now they have the control over it, so they can go to people and say, look, we like you, so you don't have to pay your money back. We don't like you, you have to pay your money back. It's the politicization of credit. It's part of what the Democrats have wanted for a long time. And again, every time a bank fails, it gives them a chance to sort of move things in that direction, and that's bad long-term for the country.
Just a point of clarification, when Mick and I were in Congress, we tried to address this problem, taking power away from the GSEs. We were unsuccessful, Mick, because there's a huge lobby behind this.
I wasn't pointing at you.
I know, I was just making sure we're clear on that. We tried to deal with this, Mick, but I want to get your take on this, because Title 42 is set to end next weekend, and the White House is giving itself a pat on the back saying illegal immigration, Mick, is down. Take a look at this.
Actually deal with the immigration system in a humane way. That's why you've seen the parolee program be so successful. When it comes to illegal migration, you've seen it come down by more than 90%. But we know that more action needs to be taken. So it has to be legislative action. We're going to continue to call Congress to do that.
So, Mick, you served in the White House. I mean, this is a bold-faced, flat-out lie. Illegal immigration has exploded. How do they get away with lying to the American people? Illegal immigration down by 90%?
Yeah, because there's, aside from this network and maybe one or two others, no one's ever going to press her on that. I mean, it's really, the press is doing, the media is doing a disservice to the country when they allow those types of answers to be given without pushing back. I do think it's noteworthy that every time the White House wants to do something, they don't need Congress. But when there's something they don't want to do, they say, oh, well, we're waiting on Congress, which is exactly what's happening here. So, look, I don't think Karen Jean-Pierre has much credibility. But again, I pay attention. And it's a shame that we don't have an active media sort of pushing back when she says things that are absurd as that, because that's just not right.
Mick, great to see you. Mick Mulvaney.
Enjoy the conference, Mick.